All right, here we are. We're live. All right, good to see everyone. We have an exciting panel for you now, and so we've got a couple of different types of institutions represented here. I'm going to have you guys go around, introduce yourself, tell us what you do in the in kind of the crypto ecosystem and how you plug in, and then I'll have some questions that we can get into. All right, sorry. So let's have Monica. Would you please kindly start for us?
Okay, yeah, I will start. So hello, everybody. I'm Monica. I'm head of marketing and partnership at LTP. So LTP is a digital asset prime broker. So our headquarters in Singapore, and we provide DMA and latency solutions and prime services for hedge funds and the trading firms. So on like Pyth network, we are the top 10 data provider. So focusing on providing low latency data and like precise data. So yeah, it's great to be here and share the thoughts and connect with everybody.
All right, great. Thanks so much for coming. Okay, let's go to Guilhem from Flowdesk. Could you just give us a quick intro on yourself and who Flowdesk is?
Hi, everyone. Pleasure to be here with you guys today. So I'm Guilhem. I'm the CEO and co-founder of Flowdesk. We've been doing this for slightly more than 3 years now. We are one of the key market makers in the market. We are notably known for our product called Market Making as a Service, which is a new approach to managing liquidity, where token issuers have more control over their trading capabilities. We are 100 people operating globally in New York, Paris, Toronto, and Singapore.
Very nice. Cool. And then Thijs, am I pronouncing it correctly?
Yeah, it's correct. Hello, fellow Pythians or Pythians. I have no idea how you pronounce it. Well, I'm Thijs with VanEck. VanEck is a traditional asset manager. We have been really much engaged within the crypto community. I think most of you probably know us from the VanEck Twitter account. So VanEck manages around $80 billion assets under management. And of that is around 1 billion in crypto. I work as a trader for the Active Fund, which is the digital asset alpha fund. And yeah, we trade on a daily basis, making active choices, where to have exposure on and where we should not have exposure. And really excited to learn more about Pyth today.
Excellent, cool. Well, why don't we start there, Thijs, and why don't you tell us some of the things that you find to be interesting about the crypto market from a market structure and access perspective that perhaps are different from some of the other markets that VanEck accesses?
Well, yeah, I think one of the things we're seeing on a daily basis is, of course, liquidity. I think the crypto markets last year were a lot less liquid compared to the traditional financial markets. And I also think that these data on the order books, for example, is very important for a trader at VanEck to see what's actually happening in the order book. So I can just see how many sell orders are there and how many buy orders are there from different parties. And that's also important in TradFi, but it's also important in crypto to have reliable data and fast data. And yeah, we are so one of the things we are using right now is Crypto Compare. It's a third-party data source. It's not a first-party data source, where we make our decisions on every day. So pricing data is really important because it shows how much a Bitcoin is worth today, and there we have to make decisions upon for the next day. So if we think Bitcoin is priced wrong, then the whole book will of course change in our portfolio. So then we have to make changes based on wrong prices, which doesn't make sense. So yeah, for us, pricing data is really important on a daily basis.
Interesting. So, Guilhem, why don't you tell us a little bit about the way that you connect with exchanges, and you know, I want to maybe set the stage for us to learn a little bit about LTP and how prime brokerage is something that hasn't yet been established as a ubiquitous feature of crypto, but it's probably something that's really needed. And if you could just tell us a little bit about just access to markets and what makes crypto unique.
Yeah, sure. So, you know, I think at the end of the day, if you look at market making or whatever the underlying, the only thing that matters is, are you playing same level playing field as the other guys? So that's true from a financial standpoint. Do you have access to capital? What is the cost of capital? What are the fees you pay on exchanges? That is true from a quantitative standpoint. And of course, that's true from a latency standpoint. What is the key difference in crypto here, obviously, is the latency to exchanges and the number of exchanges, because this is a global market. So at Flowdesk, we are connected at slightly more than 130 venues, which are centralized and decentralized, which leads to other issues that I'm sure we will talk about. But yeah, it's a big thing. It's a big thing because you will not trade the same way on centralized exchanges and on decentralized exchanges. And of course, in TradFi, most of the time you will connect to a single venue. And that's why the order of magnitude, when you look at latencies, it's completely different. You will typically look at nanosecond or microsecond, whereas in crypto, you are more between microsecond and millisecond, and sometimes arguably even higher, particularly when you trade on blockchains where you have the implicit latency of the blockchain. So I think at the end of the day, it's a problem that is arguably 10 times, 100 times more complex than in TradFi, because the complexity is exponential with the number of trading venues that you connect to. And then it's about arbitraging which venues do you want to connect to, which liquidity do you want to tap in. We're talking about the counterparty risk and all of that. But yeah, the connectivity is a big piece of the puzzle. And once you have the right connectivity at the right latency, that's a big pain point already that you have solved.
Yeah, I like how you said being on an equal playing field is the most important element of that. And it's competing on the time scale for those markets. And so for centralized markets, as you say, it could be in the microsecond, well, probably milliseconds, I think you mentioned. It's the traditional markets that are probably closer to the nanos. But what we've seen even with Pyth on the development side is that Pyth is operating at sort of almost physics fast for blockchains when you're using a decentralized consensus mechanism, which is 400 milliseconds. And in the real world of centralized trading or co-located trading, that sounds like an eternity. Monica, why don't you tell us about what LTP does, what the analogies are to the traditional markets. And it was interesting to hear Guilhem talk about the single point of access. If you have traditional markets, you have a single point of access, I presume means prime broker, or even a clearinghouse like a DTCC where everything gets kind of net down. There's certainly capital efficiencies. But could you talk us about like the vision for LTP and where you are today with seeing that being fulfilled?
Yeah, so yeah, just as mentioned, I think that so LTP as a prime broker, the idea is that we, compared to the traditional market, we want to be as interactive broker. So we connect with different counterparties in the digital asset world. So as I mentioned, our clients, they are like market makers and hedge funds. So basically, they are, if it's like a smaller or mid-sized teams, they are looking for a one-stop solution so they can have the connectivity to different exchanges, including centralized exchange and decentralized exchange. Because of a lot of like smaller firms, they are not like big market makers, so they have enough resources to build their own like infrastructure, their own DeFi teams. So they are looking forward to like more professional like services like prime broker, so they can have like easy access. So the first is like we can provide them a good affordable fees, and that they can basically enjoy all the top tier like trading fees on different exchanges, as well as the infrastructure, because the exchanges there like connectivity sometimes will change for smaller teams, and sometimes they don't have the energy or resources to allocate to fix all the like technical issues and building infrastructure in themselves. So leveraging our services, they can definitely benefit from that. And also like capital efficiency. So basically a prime broker, because we have integrated with a lot of exchanges, so we are working on the like the margin management, so they can do cross margin. So that's like one big step forward. And also earlier we were talking about the exchange risk, because earlier I think the exchanges just take too much roles kind of in the space. I think now with more institutions adaptions, our industry are moving towards a direction. More companies can get involved, and the different counterparties plays a more like dedicated roles in the ecosystem. So prime broker, custodians, and the like settlement network, they we both like plays a role in there, so we can be like supervise on each other to make the ecosystem as a much safer place. Plus, like we are also working with different custodians to provide the third-party custody like services, which like I think tried our best to manage the counterparty risk. I think that's something I think a lot of like funds they are looking for, and I think that also will help the traditional world to adapt like digital asset space like easier and faster. Yeah, and currently LTP we are the biggest in APAC. So like the firm is still quite young, but we have made a lot of progress in the past 2 years.
Yeah, it's very nice to hear how you have segmented components of a traditional prime broker, and you're sort of focusing on the access component while looking at potentially outsourcing some of the custody stuff, so that you don't have to be the single point of failure or trusted kind of node within that kind of infrastructure. Whereas on the traditional side, it seems like most of the banks tend to be the prime brokers. So it is nice to see that the architecture changes a little bit. Guilhem, I want to hear a little bit more about the way that when you're thinking about connectivity and you're thinking about optimizing stuff for access, what are some of the tools that you have identified over the last few years that have become sort of the table stakes in order to be able to be successful? And how has this landscape evolved in terms of competitiveness? Are there more trading firms in today than there have been, or has that been a bit of a drop off because we've seen sort of a bear market and volumes have kind of come down as a result?
So I'll tackle the second question first. Definitely the competition has been easier recently for two reasons. I think the first one is just the crypto market cap, volume, everything, the bear market. Let's put it in a simple way. And the second reason is regulatory. Everything that happened in the US recently, lots of market makers unwinded their operation, they reviewed their model and so on and so forth. So that's one of the reasons why 2023 was particularly a very good year, our best year, because yeah, we've been able to grow in a very different environment. Now, on your question with regards to the technology, I think it's definitely the complexity of doing trading in crypto, as we highlighted before, is so high that you really need to pick your battle of what you want to do and where you are adding value. Are you adding value on the quantitative part? Are you adding value on the latency part? Is it on the product, the branding, the regulation, whatever? And there are definitely some battles that you don't want to fight. The custody one is one that we decided not to fight because of the security and everything you can imagine. And when it comes to executing trades in DeFi, that's a very big piece of the puzzle. However, for the rest, when it comes to connectivity to exchange themselves, the software component, everything is built in-house. So we've been adding those exchanges one by one for the last 3 years. When it comes to pure connectivity to exchanges, we are relying on the third-party providers, which help us lower the latency, get direct to exchange, VPC pairing, a whole bunch of optimization that you can do directly on the external latency, or optimizing the VMs that you're working with, because obviously in crypto, most of the trading is done in the cloud and not in dedicated servers, which is an important point when it comes to trading and latency. So yeah, that's a few things that come to mind. Integrating all those exchanges is a very big piece of the puzzle. Making them standard one to another, it's a very big piece of the puzzle. At Flowdesk, we choose to pick that battle, among others. This is definitely not something I would encourage others to do, as indeed the market is getting much more mature in terms of technology provider which provide connectivity. It's without a doubt, and yeah, you don't need to reinvent the wheel every time. And if we had to redo it again, maybe that's one of the different battle that we would fight.
Yeah, that's a good point. It's difficult to always continue to benchmark yourself against the off-the-shelf solutions and make sure that even though you have this architecture that you designed, you don't get stuck in this sunk cost fallacy trap where because you've designed it, you put all this money in it, you're unnecessarily burdened to it. And so it sounds like you do some benchmarking to make sure that it's still worth it to continue to do it on your own. And at some point you may not In the usage of Pyth, I think when Pyth first went cross-chain, we found that there were plenty of projects that had built an Oracle themselves, and they thought that that was their USP. And then they quickly learned how much thought had gone into Pyth and how many publishers there were, how fast symbols can be brought up, how resilient it was. And it didn't take too long before you start to see these chip away. And some of the panels yesterday, the presentations yesterday, some of the presenters talked a little bit about this. Okay, so Thijs, this is you're in a different type of investing, obviously, than the systematic or market making that Guilhem does at Flowdesk. Could you tell us a little bit? Obviously, we know VanEck from an asset management perspective, but what does sort of a day in the life look like for you from a trading point of view?
Yeah, so I was also going to mention this. So VanEck has multiple products. So we have all traditional ETFs, which are just basket of stocks, of course. And all these stocks are also priced, and they also need a net asset value at the end of the day. And all these pricing of stocks should be right in the ETFs. And at the end of the day, we should publish the price of the total ETF, which is the basket of stocks. But on a daily basis, I'm mostly looking at crypto projects and trying to invest for the active fund, which is just a hedge fund. The hedge fund is managing millions of dollars, which should be invested in crypto tokens. And I'm then trading on multiple centralized exchanges. We are not trading on any DEXs, and we're also not doing any market making. So yes, there's where the difference is. Also, things we are looking for in the future, what I think would be nice to have in the future as well, is maybe tokenized ETFs. We have tokenized bonds today, right? So there's some traditional asset managers that launch tokenized bonds, which should also be priced. From a traditional asset management perspective, you can also think about stable coins. So there's a few of these asset managers. I think UBS was also looking into the stablecoin today, which they announced. And all these assets that they manage to as collateral for these stablecoins should always be priced consistent, reliable, and fast to know that there's enough collateral for these stablecoins to be valuable back to $1. That's one thing we're looking at. But I'm also so these are the more usual stuff. But I'm also looking at. I was just talking about liquids. This is the liquid stuff, the more usual stuff that everyone's looking at, like bonds or government bonds. But I'm also looking at illiquid stuff, like small and medium corps that need a listing to raise a bunch of cash to go to the exchange, which can be easily done on chain, of course. So maybe that will be a new market, but also illiquid stuff like art or a wine bottle or Pokemon cards or like these kind of stuff. It all has to go on chain somewhere. And who's going to price all these illiquid stuff? So maybe we have already seen that the Pyth network is like the data publishers are already like increasing right now. But these are the regular people like Cebu, like maybe Euronext going to join the network too. I have no idea. I'm not. That's not announced yet. If all these financial market data people are joining the network, it also makes sense to maybe have some other people join the network as well to also publish data, and then maybe I can have my maybe we can price your neighbor's car in the future. And then I was just thinking about this, like maybe there should be data. There's going to be like data publishers in the future that are going to price different assets that we're not thinking about today, and that's how I can see maybe the data publishers grow for the Pyth network for these type of assets. I would love to see some pricing for other stuff that I usually go to eBay right now, and then I see what people are bidding for my illiquid assets. But maybe there's also people that can price it for me. So I was just thinking about this for the future Pyth network.
Yeah, I mean, I think that the grand vision is, anything that could be viewed as an asset should potentially be able to have a price in the future. But Monica, why don't you tell us a little bit about what's the furthest that you'll stretch out in terms of comfort around different asset types, and then where are sort of the limitations today? Because there are thousands of crypto tokens. There's obviously a category of the fungible ones, and then there's NFTs, which are way more complex. What is available for LTP? and what do you think could potentially be in scope in the future? And then sort of what do you think are the practical limitations for expanding symbols within the prime brokerage coverage model?
I think I will maybe talking about the asset class. I think not only like related to LTP, I think for the whole industry. I think it just like now we have like more than we have like digital assets and cryptocurrencies, and also there are more like traditional finance assets like using the tokenization to be more like accessible and have more liquidity. I think for the future, I think just like internet adoption, I think there like takes time for we have more access to different asset class, and there will be a progress. I think just like the development of the internet, that we have different key phases. Each phase is like will be impacted by like technology achievements and increased connectivity and the changes in how people interact with the online resources. Back to the topic, I think when it comes to different asset class, especially related to TradFi, and I think now the hot topic is RWA, real world asset on chain. I think that there will be a process. So we have to think about there are like few factors can impact on this. So including, I think, not only the challenges like posed by regulatory variations across different jurisdictions. Additionally, we have to maybe deal with the complexity of managing like real world ownership records and implementing with effective like asset custody like solutions. So based on that, so first now we already have like different tokens and all these assets originally from blockchain technology, Bitcoin and altcoin. I think the second stage now we are dealing with like the digitalized financial assets, such as digital bonds and digital golds and T-bills. There's a lot of firms are like working on this. So with just with the implication of with the intermediary infrastructure in place, the implement of those like some regulatory frameworks to minimize the credit risk. I think on-chain adoption for those type of assets will be like relevant, like straightforward. And also now we have more use cases, dealing with some non-traditional assets, for example, like art and NFTs merge as a solution, which like liquidity is still like lower, but we do see some like very creative use cases. I think then later we will maybe explore some more non-standard assets like real estate. It's also a hot topic, but I think it will be a little bit tricky because only a property, like the rules can be very different from places to places, making it very harder to track. The ownership can be very hard as well. So I think that and also like custody by the real world like real estate can be also like very tough. So but I think in the conclusion, as we move forward, I think step into the future, I think the the technology definitely will drive more like real world assets into the space with more liquidity and more accessibility with this like 24/7 trading, and fundamentally change how we interact and invest in the real world assets. Yeah, so that's a lot of topics about the asset class. And then like, I think as a prime broker, so now we are dealing with the crypto native or the tokens. Our goal is to provide the infrastructure and solutions for them. And later on, definitely, I think the TradFi is finding some solutions for digital assets and tokenization, all the like financial assets. While we come from the crypto native space, and we are also working on different approach. I think eventually the two worlds will kind of merge, but we will have different edge and different specialties and working on different asset class.
Really cool. I love the way that you frame that as well. It's the categorization, crypto native. Yep, we're here today. Then there's the like TradFi native existing product with a potential leg for crypto. And then there's a question on how that happens. And then there's not really an asset class that's heavily traded today, the vanguards of the market. And that's probably a bit further out, requires a bit more thought. Really nice. Guilhem, talk to me about how you think the merging of real world assets with crypto assets could potentially work. We do have some, right? So we have obviously stable coins, and there's a real use case, especially down in places like Argentina, where you want to hold on to something that's secure, and getting something that has a developed financial ecosystem behind it is really important. But this could expand, right? It could be that there's demand for not just something like treasury bills that would even pay some interest, but maybe there'll be bonds and perhaps some equities. But as Monica mentioned, there's complexity to how this works. Do you have any views on how this potentially could pan out, and how you guys are perhaps set up for the future trading of these types of crypto assets?
Yeah, thank you. I think it's particularly interesting question. So at Flowdesk, our vision is simple. We are a big believer of tokenization from day one, and arguably this is the most interesting use case for crypto, if not the only interesting use case for crypto. Obviously, there are tons of interesting things if you look at gaming, but revolutionizing finance through tokenization is a 100x factor in terms of market size, if you look at it from any perspective. So that's what we are excited about. And I think if you look at what crypto has done in the last 10 years, is just building the fundamental blocks for this. We were 5 years ago, 6 years ago, in a completely different world than where we are today. We had the ERC20 token. We had Uniswap, which introduced a UniV2, UniV3 model, which allowed DeFi to happen, simply put. We had more recently order books. We had the scalability with the layer 2s, and it's going on. And what we are seeing on the RWS side right now is exactly what we all hoped for. It's picking up. They are having their 2017 moments. The market cap may be relatively low, $10 billion, $5 billion if you exclude stablecoin. But in early 2017, crypto market cap was in the north of 25 million or whatever. So I think, simply put, the technology is there, and I think we will trade those security token the same way we trade the utility token today. It's going to be fungible token. ERC20 standard going to drive most of this, and it's going to be non-fungible token for assets which are non-fungible. And obviously, there will be some very special features. Some token will be non-transferable. Some token will be transferable according to governance, non-burnable. Some token will be permissioned. I mean, everything we could think of, but we have everything here. And that's what we are preparing for Flowdesk already today, working with hundreds token issuers, is just preparing for this for the future. And then obviously there is the regulatory component, and that's why this transition is going to take 5 years, 10 years. But the vision is simple. Tomorrow, I think every single asset that has value will be potentially tokenized, and that will open a completely new world to assets which were illiquid until today. If you think about equity, today there are more firms that do not have secondary markets than firms who have secondary markets. Tomorrow, the grocery store of the corner might be tokenized in an ERC20 token, and it's going to be a $1 million market capitalization traded on Uniswap or wherever. And again, it's going to be different. Likely it's going to be permissioned. Likely there is going to be some additional stuff like distribution of dividends and all of that. But this is where we are heading. And I think, and that's why the first step that we are doing now in the RWS space is very simple, but yet it's the most important one. We are bringing the yield on chain. It's that simple, and yet it's so powerful, because now anyone can have access to this 5% US Treasury yield, slightly lower if you look at Euro market, but already the use case is here. Virtually, we are just days, weeks, months away from people being able to buy treasuries in a very healthy and efficient manner. And that's a huge use case on the B2C side, obviously, but even on the B2B side, because what's going to happen next? It's going to happen exactly what we have seen in utility token until today. You will use the asset as collateral, and it's the beginning of everything. And that's why we could not be more excited. And I think it will first happen with treasuries. Bringing the yield on chain is a huge piece of the puzzle. And I guess the next step is equity. And we are already, seeing this bridge where companies which are not crypto companies, have a secondary market much earlier and earlier in their life, traded, you know, on some venue, notably in the US. So, you know, people want to have access to that liquidity as early as possible. Even, you know, even B2C market want to invest in this company as early as possible. And I think tomorrow, every seed stage company that will have done a seed round with whoever will have a security token linked to their equity, and it will be traded actively. And that's why with Flowdesk, we have that vision combined obviously with the fragmentation of the markets, that market making is going to completely change. And that's what we are preparing for. It's going to be completely different. It's going to be much more scalable. And that's why the technology component will be a key part of that change.
Yeah, it's really interesting that you mention it in this way. There's certainly the standards and the technology that give the potential for things to happen in a much more streamlined fashion. For instance, right now, it's unreasonable for a local grocery store to syndicate itself just because the legal bills and then the listing process is just out of reach for them. But if it was as simple as doing some sort of an ERC-20 and it was standardized, and maybe it's like I upload my financials and people understand, you know, that certainly makes sense. One of the big breakthroughs that we tend to have within technology is a breakthrough on the reclassification of industries that have very prohibitive rules against expansion or innovation. So one of the reasons why Uber has been so successful is because it's not a technology company, or sorry, it's not a taxi company, it's a technology company. Every taxi company in the world wanted to do what they did, but they were confined to their local regional regulations. And so the reclassification, I think, makes a lot of sense. It's great framing. There's like all these cobwebs and clunkiness within the system that when you look at it with a fresh pair of eyes, you say, if I were to build it again, I would do it slightly differently. These, you know, could you tell us a little bit about this potential of reimagining regulatory capture and maybe where there's pockets that if regulation is done right, or maybe where it's done so wrong, where it will unblock things, and what needs to be done for it to potentially unblock it, if you have a particular view?
Sorry, is that a question for me?
No, that was for these from VanEck.
Sorry, I didn't notice it was for me. Yeah,
apologies.
It's of course a very important thing to also come across. So that's regulation, of course. I think we aren't there yet for security tokens to work. So we were just talking about security tokens. There should be regulation first. And I think MiCA is doing a really good job. So MiCA is going to launch next year. It's a European regulation under which you can just launch security tokens, but also stablecoins. So we will see our first regulated stablecoins next year. We've been speaking to many of these parties, and they're all in the race of getting e-money licenses now, and then launch on the MiCA regulation. And I think that's the first step to get a lot of assets under management within on-chain assets on the stablecoins. Then I would think treasuries is next, like already mentioned, and after that securities. But the regulatory environment is changing. It's going at a slow pace for almost 10 years, I think. Regulation is finally coming to crypto. I've always been a big, was always a big approver of regulation. So I really love that these, the lights are going on again. Also a big fan of regulation, and hopefully we can find a way in which the regulator understands crypto and also sees what type of technology we have here, where we can trade peer-to-peer without having an intermediary, trade securities. And we already were talking about it, listing your company, making it tokenized and sell parts of your company online. It can be that easy. Or maybe tokenize your house, fractionalize your house, and sell it on chain. It should all be possible in the next 6 to 10 years, I think. I think in this round we are seeing the first regulation happening, and yeah, hopefully it will be a good thing for crypto. But I think it will be. For some of these tokens, it's better to be a security than a commodity. So hopefully we can see some of these tokens actually being a security, and then under SEC or MiCA regulation, and trying to move forward from there. And I don't see that as a bad thing.
Yeah. And so we've already talked a little bit about the categories. So Pyth data covers several categories. There's 400 symbols, 25% of them are real world, but 75% of the bulk usage is all crypto. A lot of those ones that are out there are representative of what's possible, and so it's almost like a it's almost like an olive branch or a carrot for developers. You know, if you want to do and build something here, it's available to you. We haven't seen the uptick of it. I assume that part of it has to do with the regulation of it. And I don't know if I would love to hear, Monica, if you can think of anything as we sort of kind of expand our aperture a bit from crypto. If you can think of any ways with which there could be unexpected areas of growth. So we're obviously all here focused on DeFi. I had a panel earlier today where a lot of the talk was around the innovations of decentralized physical infrastructure networks. And so there was kind of onboarding of people in the deep end. Are there any things that you think could be major catalysts to the expansion of, you know, just kind of the general usage of blockchains and its potential streamlining effects, or if there's other sort of things that you could think could potentially draw people into kind of the asset class, even as a category?
Okay, it's a very big question. But maybe I can just focus on some like the maybe something stopping us to move forward. There, I think for the blockchain adoption and the on-chain trading side, there are still some difficulties that are stopping us moving forward. We are talking about all the infrastructures, and I think that's work in progress. And I think there are something we see has not been substantially improved. So for example, I think the on-chain security is still a very key factor for us to moving forward. Yeah, because like for the every year, like we witness a lot of incidents, billions of dollars that got hacked, and on-chain custody solutions and protections is still not enough for us to not good enough for us to protect our asset and capitals. I think that's something we really need to find some breakthrough. And I think the second point is that for the on-chain transactions and stuff, I think the cost is still like something we need to work on. So like even for professional traders, right? So when they do the on-chain trading, if their like MEV got attacked, the transaction cost will go up, and the slippage will be like wider. So I think there are the two things that even for like very professional like traders are still like didn't see enough like improvement. But we do see a lot of like just as I mentioned, the infrastructure has built to improve, I think, the adoption for the blockchain and on-chain transaction. So like one is we currently I talk to different firms. They are building some really interesting DeFi on-chain product to serve institutional adoptions. They have like, you know, like on-chain collateral management and portfolio like margins kind of products. I think those products are really good and very exciting that they can actually bring more institutions adoption for like on-chain trading and stuff. Yeah, I think that's something like you know, related to trading side. I think that I want to share, and if those issues can be solved or like improved, I think on-chain transaction or trading will be more attractive.
Awesome, great answer. Thanks so much. Guilhem, keep us honest on DEX trading. How is it today? How does it compare with centralized exchange trading from your experience being in the weeds?
Oh, it's completely different. It's completely different from many perspectives. So from a technical component, just to spend a second of it, it's much more different than trading with a simple API key, which doesn't offer the same level of risk from a security standpoint than having literally a private key in your hand. And that's why when it comes to operating on DEXs, You have to rely on some technological solutions like MPC, multi-signers. You have to basically break down the keys, and just the access and the signing and the security part is another level of magnitude in terms of complexity. Now, if we look at trading economics, again, it's a completely different piece of the puzzle. On centralized exchange, you have literally the best innovation that was invented until today to make market happen. It's an order book. At what price do you want to sell? At what price do I want to buy? We're mentioning an example about eBay earlier. This is exactly how we make markets. And that's until we invent something else, literally the best way to create a market. Obviously, Uniswap has invented a new model for efficiency purposes that is completely different. But that model implies some costs, which ultimately are paid back by the guys who trade on this. It's not there is obviously the impairment loss, but the trading fees have to pay back for the impairment loss. So ultimately, what does it mean? It means that it's more expensive to trade on chain. And we're not talking about scalability necessarily here. We're talking about the intrinsic model, UniV2, UniV3. And that's why Uniswap, like any other decentralized exchange, is doomed to have as close as possible as an order book model, which is ultimately what they are leaning towards, because otherwise the competition will eat them up. But ultimately, if you look at the recent wave of innovations, we are seeing on chain very similar products as on centralized exchanges. If you look at derivatives, for instance, obviously the collateralization is much more efficient. So that's really something that is interesting. And all these exchanges are slowly but surely adopting order books. And that is because of the scalability that is offered by the layer 2s or by running the order book off chain. That's why it's very likely only a matter of time, 1 year, 2 years, 3 years, until we will trade almost the same way on DEXs than we trade on centralized exchange. And because the security component I was bringing earlier will be abstracted by multiple providers that are building very interesting technology solutions. So I think this is really how we look at it. Obviously, if we look at the picture how it is today, liquidity is still much higher and much cheaper on centralized exchanges. And that's why when you've said this, even assuming there is a strong conviction that liquidity will move on chain, centralized exchanges will exist for pure latency reasons that we highlighted earlier, which is it's a completely different order of magnitude. It's down to the millisecond, whereas as you highlighted perfectly, blockchain have a physics constraint where it's in the hundreds of milliseconds. Of course, centralized exchanges will have to converge towards decentralized exchanges, notably from a non-custodial standpoint. And we are seeing some very interesting initiatives where, again, the limit between a DEX running an order book of chain and a centralized exchanges running a non-custodial approach, it's very similar. So I think ultimately both might converge. But yeah, this is how we are looking at it. And again, adding on top of that the complexity of the number of chains make this even more complex, interchain operation. So yeah, today it's still a pain in the ass to trade on chain. Let's put it in a very simple way. We're not talking even about compliance here, about money tracking, anti-money laundering, because again the funds are fungible. So you know what funds you put, you don't necessarily what funds you get back. And yeah, that's still a complexity, and that's another big challenge that the industry will have to solve in the next years.
Cool. Thanks for giving us a good mark to where we are on the innovation. We're coming up to the end of our time here, so I'm going to do a quick lightning round. We've done this with some of the others, but if you like a very short, unconventional take that you may have, or controversial take, even if you're so bold. These will start with you if you have any last controversial take about the crypto markets today.
Controversial takes. Yeah, we do have some. I'm not sure if I can announce them right now, but controversial take would be total value secured for Pyth network will be next year. Where are we today?
About 2 billion, yeah.
Okay, will be above 20 billion next year.
All right. Monica, why don't you go next?
Okay, I don't know. It's a very interesting question, but I think my take is I think still like a global adoption I think still like there are more countries accelerating the adoption for digital asset. For institutions focus, even like some regions are quite challenging for like retail investors to access for the digital asset. But I think generally, we are moving to a greater maturity. And I think one interesting things that you have mentioned before is Argentina. There is a lot of bold initiatives, challenging the role for central banks, like in some regions. I think that's also that it's just like a social experiment that we can see like what's happening in the future. Yeah, nothing like super big. That it's just like I say we are living a very interesting time.
May your time be interesting. All right, so let's finish this up. Guilhem, any hot takes you'd like to?
I'm going to get one more contrarian.
All right.
Next year, DEX volume will be a lot higher than SEX volume. So I think there will be more trading. On
which particular, any particular segment of it, like derivatives, spot, or everything?
Spot over spot.
Spot. Okay. All right. I'm a believer in the derivatives getting to parity, but I like hearing the spot volume prediction. I think that's a very good one and definitely unconventional. All right, Guilhem, why don't you finish this off? Give us your dirtiest hot take.
So I guess my take will be one I hope I will be wrong about, but if you look at a more statistical historical perspective, I think we are not in a bull run. And again, I hope that I am wrong, but we are very much early. There are some metrics, notably the historical metrics that were looked at in terms of like Google search, tweets, activity, social network activity, which are still very low. There are a great number of reasons to be very bullish and very excited about crypto, and that's been the case for the last 2 years, if you look from a technology standpoint. But there are the same number of reasons that everything could go wrong. ETF application could be delayed. There are the hacks. There are malicious actors. The regulatory is a big component of it. And so my thought is that if you look more from an historical perspective, the bull run is probably more for end of 2025. But I hope I'm wrong about this one.
All right. Well, I hope you're wrong as well. I am very privileged to have shared the digital stage with the three of you. Thank you so much for spending your time with us, and I wish you guys the rest of your day as a nice and pleasant one. We've got a next presenter coming up today. Is going to be from Movement Labs in about 15 minutes. All right. Thanks so much, guys.
Thank you.